Thanks for joining me today as we talk about a rising problem for AI, and that is interest rates. But it doesn't impact all AI companies or all tech companies the same way because they each have a very different position on debt. But let's look at what's been going on in the AI infrastructure boom as more and more money is being invested in the growth of AI. So what we see here is a chart that shows the growth over the last 4 years. The 2007 is an estimate, even 2006 is an estimate, but it's pretty accurate because companies have already indicated how much they're investing. But this is the big AI companies: Microsoft, Alphabet, Meta, Amazon, and Oracle. So the big five, how much they're putting towards the growth of their AI investments. And you can see it's slated to be over $1 trillion next year. And that, this may be the first time you're hearing that big number, but we're pretty confident it's going to break $1 trillion next year. So the interesting thing is debt is funding a bigger share of that investment. You can see a kind of tipping point hit between 2025 and 2026. Only 12.5 billion was financed on debt. In 2025, that grew to 220 billion in 26, and it's going up even more. But that debt is not being experienced by all companies, just some of them. So let's look at that. But first, higher rates change the game. Why is that a big deal that they're paying more for debt? One, new debt costs more. Of course, every 1%, if you have 40 billion in debt and every 1% increase in interest rates is 400 million more you have to pay back. Lower valuations, future cash flows for AI are discounted. And of course, investors have other options. They can invest in more safe investments. So obviously that will further make it harder for them to continue to raise money. But really what we're going to look at across these companies is capital expenditure, which we just described, and how much that is relative to their operating cash flow. Thus, do they have a positive free cash flow or negative free cash flow? And if it's negative, that means you have to finance things. And you can see down below, here's some ways what they can do if their cash flow is negative. But let's look at the landscape here, because not all of these companies are treating debt the same way. In fact, Microsoft, Alphabet, and Meta, they have positive free cash flows. They're doing just fine. So they're not at risk of these rising interest rates. Amazon and Oracle, however, are. And the folks at the most risk are the folks on the bottom of this pyramid, the neocloud companies. You can see them listed there. I won't mention them all, but they're all highly leveraged. They're all growing really fast. They're growing really fast because there's tremendous demand, but they're taking a lot of risk because they're growing so fast that they're going into quite a bit of debt. So if I was investing, I would invest on top of the pyramid and not the bottom of this pyramid. So let's look a little closer at Oracle. So you can see their operating cash flow is 32 billion. That's a record. There's incredible demand for their services and their AI services. But they're spending 55 billion. So they have 23 billion in negative cash flow. That's really high, much higher than any of the other big hyperscalers, and especially relative to their earnings. Amazon is slightly negative cash flow as well, but their earnings are so much higher than Oracle that it's not as big a risk. So just to give you a comparison, Meta and Microsoft are spending more on AI than Oracle. They're spending 64 billion, 80 billion respectively, but they aren't borrowing money to do it. They still have billions of dollars in free cash flow. So Amazon, on the other hand, is slightly negative, but they're spending more than anyone else. They expect to spend more, about 220 billion on capital expenditures in 26, with much of that going to AWS and AI infrastructure. So their free cash flow is negative, but their earnings are so much higher than Oracle that their debt to earning ratio does not put them in the same risk category. And that's why on the prior slide, you can see Amazon is above Oracle in terms of risk, but still slightly below Microsoft, Alphabet, and Meta. So, what could go wrong? What could possibly go wrong? Well, AI revenue could slow, or the uptick in revenue may not be as quick because the competition, particularly from the Chinese models. AI computer prices fall faster than costs can adjust. Compute prices, not computer. Customers diversify. New chip architecture reduces need for expensive GPUs. There's a lot of things could go wrong because there's so much still changing in this area. So that's why I'm going to stay away from any of the companies that are in debt right now or going in debt to finance their expansion. So which companies am I preparing to invest in, or am I considering investing in? These two, Microsoft and Alphabet. So let's start with Microsoft. Their revenue, they probably have the strongest financials of any company we've mentioned today. Their revenue grew by 18%, operating income by 21%, net income by 31%, earnings per share by 32%. That's exceptional growth. Azure grew 43% in the most recent quarter and exceeded 100 billion in revenue for the first time. This is awesome. The only problem is the price. Microsoft currently trades around 24.5 forward earnings versus Alphabet, which is 16.8, and Meta, which is about 17. So we're paying a premium for Microsoft right now relative to the others. So I'm not going to buy it today, but I'm looking at it, and if I see any sort of, correction in the 5 to 10 or 10 to 15% range, I'm probably going to snatch it up. So like today, it's trading at 489 per share. If it goes down to about 430, that's when I'm going to buy it. So Alphabet is also a great company, and I think maybe even more tempting right now to buy because it's trading at 16.8 times forward earnings. That's surprisingly inexpensive relative to its history. At the same time, the operating business remains excellent. Google Services operating income was up 24% in Q1, and Google Cloud continues to expand. So they are investing a lot in AI, and I think that's why they've been penalized by the market. They have approximately 127 billion of cash and short-term investments versus only 47 billion of debt. So unlike Oracle, Alphabet has enormous capacity to finance the AI build out. It's currently trading at 343 per share. My target is anything under 330. So if it goes below 330, I'm going to purchase. And so that's just the way I'm looking at things. Let me know what you guys think. If you have any suggestions on a future video, please let me know.